Hi, everybody, and thank you so much for tuning in to FT Live's Banking Revolution Conference. My name is Imani Moise, U.S. banking correspondent for the Financial Times, and today we're going to be talking about the role that finance firms and fintech firms should be playing in supporting a sustainable future. Is it the role of banking firms, of the private sector? Should regulators be more involved? We're going to get into all of that today with our panel from both sides of the transatlantic. So first up, we have Jürgen Ridterink, first vice president and head of client services at the European Bank for Reconstruction and Development. And we have Priscilla Sims Brown, CEO of Amalgamated Bank, Martin Rohner, executive director of the Global Alliance for Banking on Values, and Bevis Watts, the CEO of Tridos Bank in the UK. Before we get started, I'd like to remind everyone that to please send questions through the chat function, and we'll try to incorporate your questions throughout today's discussion. And also follow along on social media using the hashtag Banking Revolution. And with that, let's get started. So Jürgen, let's start with you. What is your most ambitious environmental target, ESG target, and what are some of the biggest challenges to achieving that?
Well, good afternoon or good morning to all of you, and thank you, Imani, for your kind introduction. Let me start by saying just this morning we could all read again in the recent UNEP production gap report that fossil fuel production will set to soar over the next decade. Yes, many countries continue to plan for or support levels of fossil fuel production that are simply incompatible with the Paris Agreement. And to be honest, there were very few positives in the report, but the one that caught actually my eye was, and now I quote, funding for oil, gas, and coal from multilateral banks has decreased significantly in recent years. And the reason why I'm saying this, of course, because EBRD is a multilateral. So it is great that others acknowledge our role. And to answer your question about the climate target of the EBRD, let me start by saying that our commitment to sustainability is part of our DNA. And you probably hear these phrases a lot, but I can tell you that this commitment is actually really articulated in the agreement establishing the bank. And that was over 30 years ago. And it is implemented throughout our policy, strategies, and through initiatives. And we further underscored, and now I'm coming finally to your question, we further underscored that commitment when we publicly stated last year that we aim to raise the bank's share of green investments to more than 50% by 2025. And probably as important, align our operations with the objectives of the Paris Agreement by 2022. And I stop here.
And Martin, what about you? You represent an organization of a whole bunch of financial institutions. So how are you coordinating those targets, and how's that collaboration been like?
Yes, thank you, Imani. So good morning and good afternoon from my side as well. So I represent a global movement of 66 banks worldwide that are dedicated to sustainable finance and values-based banking. What keeps them together is really that they put purpose first. They put finance at the service of people and planet. And so they've been historically always very ambitious as far as ESG or also the climate goals are concerned. Now, of course, we leave it to our member banks, but I would say that our member banks we consider ourselves as front runners. We've been historically we've been applying very strict exclusion criteria, avoiding harmful activities, and already since a very long time focusing on activities that promote positive change, be it through organic and sustainable farming, be it through renewable energies. And what we've noticed is that even though we are probably ahead of most of the mainstream banks, we still have a very long way to go. So I think that the challenge is still there, not just for our member banks, but I think for the whole banking sector. At the Global Alliance for Banking on Values, we try to be a role model and set the benchmark. And we do this through our principles. Our member banks, they have social and environmental sustainability at the core of their business model. They focus on the real economy. They're very transparent, and they put their clients and the communities they serve first. So I think that's what sums it up. Like I said, I think we still have a long way to go, and I think this is even more true for the mainstream financial sector.
And how are you balancing accountability for reaching those targets as a collective versus as individual firms? Is that a consideration that you have to make as you're dealing with your member firms?
So the Global Alliance has a scorecard, and we monitor our members and see how they progress towards the goals that we've set. So we're quite ambitious, and I think the idea behind our movement is really that we help each other, that we share, that we learn from those that have applied best practices. To take the climate targets, for example, some of our member banks, they've been very ambitious in this respect. We have some members that have committed to net zero by 2040. More than half of our movement has signed up to the climate change commitment of the Global Alliance for Banking and Values. That requires them not just to measure the carbon footprint, the greenhouse gas footprint of their activities, but also to reduce that footprint along the paths agreed in the Paris Climate Agreement. So we have different tools that we apply to support our members to move forward along the journey towards values-based banking.
Okay, and Priscilla, what about you? At Amalgamated, what would have been some of the biggest obstacles getting in the way of reaching your sustainability goals?
Oh, biggest obstacles. Look, I think there are very few that are unique to us. Along with the other members of GABV, we are committed, and it's 100% of what we do. So we're a bit more of a pure play than I think the challenges that are faced by some of the multinational and larger institutions, which think about supporting the economy, and in the case of some of them, there's very few options in doing so. So they've got to have a very strong public-private partnership in order to move forward. And so I think their challenges are significantly different than ours. For us, it's a clear story. We're a ESG bank. We're a bank that focuses on social responsibility. We are a B Corp. We think in every way about doing well and doing good at the same time, and living through our mission. And in fact, for us, frankly, the more people focus in these areas, the more opportunities there are, and we believe in lifting all boats, as do Triodos and GABV and all of our like firms.
And Bevis, what's the perspective from Triodos?
Well, I mean, very much like others have said, I mean, in our DNA is more than just focusing on net zero. It's the delivery of the Sustainable Development Goals, and we've reported all of our impact against those since 2016, and that's our focus. But in the sort of net zero sphere, yes, we've committed to being net zero by 2050 at the latest under the Glasgow sort of initiative that Mark Carney's founded. But in the first week of COP, we'll actually announce our true net zero target, which will be much more ambitious. And I think it will be the most ambitious announced yet in the banking sector. And the realities are we're already a very low carbon intensity bank because we don't have fossil fuels in aviation or intensive agriculture on our books. And even for us, you know, we've spent a year looking in detail about how do you decarbonize the sectors we're in, healthcare, social housing, even organic agriculture. How do you decarbonize those? And also, you know, what net zero really means is having balanced in your portfolio assets that sequester carbon versus those that emit. It doesn't mean offsetting and just paying for someone else to solve the balance of your scope 3 emissions. So we've spent time already in thinking about how we can invest proactively in a new economy around nature-based solutions. How do we really value nature and invest in it in order to then provide revenues associated with, insurance mitigation for flooding, carbon sequestration, et cetera, et cetera. But I think that's one of the biggest challenges in everyone talking about net zero, but not really realizing what it means is a transition to a very different type of economy. And the other big challenge for us in wrestling with a net zero target is, is the race to zero, is getting there as quickly as possible the right thing versus taking everybody with us on that journey. And you could end up in a world where banks are less willing to finance some of the lower income households that have the least energy efficient properties, and you end up with mortgage prisoners or people struggling to raise finance. So I think getting that balance right of what we call a just transition in your target setting is also a big dilemma.
Yeah, I think that just that discrepancy between what the financiers want to do and what clients need is an interesting dynamic, because while banks have been very, very vocal, and the finance industry as a whole has been very, very vocal about their ESG targets and their sustainability goals, the reality is it's a very client-led business. So how do you navigate client demands and those targets when they're at odds?
Would you like me to respond first? I mean, I don't see them at odds. I mean, I see it's a fundamental obligation of banks to use their clients' money in their long-term interests. I think if you have that mindset and you are seeking to fulfill that, then those two things are entirely aligned if you have the right responsibilities in place. I mean, if you take a traditional mindset of profit maximization and greed and so on, you will end up with the scenarios I described of potentially mortgage prisoners, potentially some sectors being left behind and not supported in transition. But I don't see them at odds. I also could quote umpteen different surveys that we've commissioned in the UK for Good Money Week, but other ones that exist around the world, where increasingly there's a generational shift, and this is what people expect and will want from their banks. So, I really think the banks that don't see that and embrace that will be the Kodaks and the Blockbusters of the future, the people that really miss the big strategic shift in their sector.
Perhaps then to add, Imani, please, ladies first.
Well, I was just going to say, this is where the value of collective commitments comes in, and why we focused on initiatives like the UN Principle for Responsible Banking and Mark Carney's Glasgow Finance Alliance for Net Zero. We think these efforts are really sending a very powerful signal that every part of the finance sector is headed in the same direction and playing by the same rules over time. And there's still a lot of work to be done, but this collective approach is central. And I think having, the taxonomy that's consistent, having goals that are set and understood and clear, and working with large organizations focused on the rights of customers, the rights of the underprivileged, the rights of clients more generally, and the sensitivity that was described a minute ago around that. I think all of those things working together are the answer.
Yeah, Imani, what I wanted to say is your statement might be true in general, but many banks, let's face it, still finance coal or heavy fuel. You won't hear this here on the screen because the banks here, they're part of the converted, amalgamated America's Socially Responsible Bank, or Triodos, one of the world's leading sustainable banks. I think the reason why you have invited us is because we are still a little bit special. Having said that, because of the regulatory developments, including the pressure on many of the banks to disclose climate risk, some of you might have heard about a thing called TCFD, but also because of competitive pressure and consumer demand, we see that green and climate investments are certainly moving up on our clients' investment priorities. In fact, most of our clients increasingly understand the importance of the green transition and the risks that they may incur in failing to be part of it. For example, not being, and I'm talking here in 10 years or beyond, but not being able to access financial and capital markets themselves. So I don't think the question is not anymore if shifting capital investments towards green technologies and low carbon business model, but rather when and how. And I also firmly believe that how businesses will be able to remain competitive through this transition will very much depend on their capacity to incorporate climate risk in their strategic decisions and to how would I say it, adapt rapidly evolving market conditions. And then lastly, let me add one thing. This is also becoming increasingly important in the search for talent. Let me ask you, Imani. You're even younger than me. But do young people want to work for a company that pollutes the environment and is part of the old economy, or in a company that is trying to be part of the solution? And I know the answer. In fact, this is one of the reasons why I switched from investment commercial banking about 15 years ago to development banking, and this was before the Lehman crisis. Thanks.
So yeah, with that we could move on to the next topic. But something that's already started to come up is do banks and finance firms have the right to shun certain sectors? Bevis, as you were talking about, just not having certain industries on your balance sheet, but there are oil companies, coal miners that still need banks, and what you're starting to see pushback, for example, in Texas. In recent weeks, you're seeing banks getting shut out of the muni market for their policies around banking gun companies. So, I mean, do you think that it is a responsible thing to do to shun clients based on what sector they operate in?
Well, if I can maybe respond to that, Imani, I think banks not only have the right to do it, they have the responsibility to do it. Let's face it, with every investment, with every financing that a bank provides, there is an impact on the economy, on the society, and that in a very long term. So banks are actually shaping the future of our planet and have a tremendous responsibility. And so they have to become aware about that responsibility and act accordingly. And I think that's the difference between values-based banks that we represent at the Global Alliance for Values-Based Banking and just the mainstream banking sector, that we put the purpose first. We don't see ourselves as neutral brokers of capital, because banks never are neutral brokers. If they just follow the client demand, that means they basically accept the status quo, they accept how society, how the economy works today. And if they have their own vision of where the economy needs to go, where we want to go with our environment, with our society, I think that's when we will see real change in the financial sector. And I think that's the difference between banks that are reflecting on their values and really pursuing those. And they will be, first of all, working with their clients and their communities to help them transform, to help them adapt, for example, to climate change. But they also will be willing to say no at a certain point when they feel the values of the clients are not aligned with their own values. And I think that's what we have to keep in mind.
What I would just like to say is there's a very live conversation going on in the U.S. and I presume in other places around this notion of whether or not banks taking the approach that they are going to set standards is somehow unfair to the underserved and the underprivileged. And the historical context around this is that people have connected to this horrendous policy that used to exist and maybe in some corners does in the US around redlining. And many banks were party to this in the past. And that's just the exclusion of certain clients based on the color of their skin or the type of business they're in. And to suggest that policy and those restrictions on certain commercial activities or technologies is equivalent to this sort of blatant racism that went on is just wrong. And there's a huge, I think, undercurrent around that is misleading, I think, to general populations. And this is not just happening, I don't think, just in the U.S., but it certainly has become a live conversation here. So to be, very direct about that, we think there's no place in that conversation in the 1.5 degree world. We think that we have to have a safe world for our clients. no matter who they are. So how banks manage their transition and the risks associated with certain technologies is well within their rights. They must enforce them, and they must not get distracted by this sort of suggestion that past atrocities have a place in the current discussion. I wanted to bring that up because I think that alignment happens way too often and is frankly inappropriate.
All right, Bevis, let's go to you next, and then we'll hear from Jürgen.
Well, but I mean, on the idea of sector exclusions, we've always done it. We've always set very high minimum standards, and either if you do that, either you don't have a business because there's nobody who wants finance from you, or there's no customers who support that. So I think banks, as Martin said, have an obligation to be setting very high standards and demanding from some of the higher polluter and high emitting sectors much higher levels of performance and transition plans. And then, yes, absolutely finance them. But ultimately, if you look at the energy sector, the International Energy Association has just published a report that basically says we don't need any new coal or natural gas facilities and so on. So if that's the international expert view, then I think we need to move beyond minimum voluntary sort of standards and actually think about regulation and how that's setting a framework around what banks can and can't do, because we already have the mechanisms through risk-weighted assets. And for me, if that is the ultimate expert view and vision of a transition plan, we should be putting red lines and very high risk weightings on those type of assets. So it goes beyond the sort of the idea of rights and obligations to actually, does this make actual sense anymore?
Of course, Imani, my colleagues are right, but the reality, of course, is also that every bank has its own policy and portfolio strategy, which take into account the objective of their individual investors. And we just heard that of the policy and the regulatory environment. And that, by the way, depends from in the countries where they operate. In other words, it is already happening in practice, but it's not as simple as maybe my colleagues say it is. Let me give you an example at the EBRD. We work in 38 emerging markets. And for us, our Paris alignment approach is for us, let's call it the guiding principle to determine how our investments support low carbon and climate resilient development. For example, in the energy sector, and we just heard a reference to that, we would actually consider still fossil fuel projects, but only if they support the low carbon transition in line with Paris Agreement. This excludes, of course, coal projects, which we consider non-aligned, irrespective of their specific country context. But it really depends a little bit on what country we're talking about. And I can say, if we have time, I can give you a few examples in, for example, Egypt or Uzbekistan with that. Thanks, Iman.
Okay, and we're starting to get some really good audience questions coming in, so I'm going to pivot to those. And another reminder, please keep them coming. So one question from the audience is there a gap between what's being promised and what's being delivered by banks in terms of ESG? Pledges are everywhere now, but is real progress being made? Priscilla, why don't we go to you first on that one?
Is there a gap? Yes, there's a gap. Part of that is because this change has taken place in a very short amount of time, and it's affecting everyone in the sector. And as I said, we still have businesses that are in transition that banks want to support. Part of that is because technology has not yet caught up with our aspiration, although we're all optimistic that it will get there. And part of it is because that there are many other adjacent sectors that have not yet bought into this in the same way. I think we're in transition. That will change. We will move in the right direction. I think most banks and their clients are pressuring them to recognize the realities of climate. And I think there will continue to be the need for those who are not yet on board to establish a transition plan. So I think we're moving in the right direction. We're in a storming phase, but I think the industry is moving correctly.
Bevis, what about you? Where do you see the largest gaps?
Well, I mean, for my sins, I've been working in sustainable finance for a good few years now. And where we are now, in terms of TCFD, in terms of climate risk regulation and things, was unthinkable even 10 years ago. Where we will be in 10 years' time will be a completely different place, because we're in a sort of developmental phase, as Priscilla said. In a few years' time, we'll have, I think, robust taxonomies in place. We'll have product labeling standards, which will all bring great maturity and scrutiny to the sector and what people are really doing. But what in terms of what I was saying earlier in our own aspirations, we're in the foothills of the debate of how we need to change this industry. And people who are just focused on ESG, that's just one notch up from where we've been. But the kind of minimum sort of risk assessment you should be doing on environmental, social governance issues within organizations you lend to and invest and so on is just one notch up from where we've been. We need to be going several notches up towards true impact alignment to the Sustainable Development Goals and transition plans being mandatory. And so I think if I fast forward 10 years, people will realize now those that think they're doing great work on ESG are climbing the foothills, and they'll get to the top of the foothill and see Amalgamated and several others that are a long way up the slopes of the mountain we really need to climb.
Thank you. Jürgen, anything to add on that one?
Yes, actually, I see another gap, and let me combine that with your earlier question to one or two of the panelists on the challenges, because some of the challenges we are facing I actually haven't heard yet. Probably the biggest challenge we face is actually a shortage of bankable climate projects, and several factors in I believe limit the supply of such projects. And by the way, I'm always talking about my emerging markets background, so it might very well be different in Germany or the Netherlands or the UK or so. But what the supply is limited, and the first and most fundamental reason is the lack of either an implicit or an explicit carbon price. This means that many green investments are simply not commercially viable. And I believe that is the core of the problem. Of course, we all know that some green projects, notably renewable electricity, are now competitive even without a carbon price. But even then we see that in some cases they are held back because of regulatory hurdles. In addition, we see that in many emerging economies and developing countries, there's a gap in climate data and limited technical capacity. And by the way, in some cases also insufficient political commitment in supporting the transition. Imani.
Thank you. And I think that brings us to a great topic, that shortage of projects to finance. I think that's one of the contributing factors to these greeniums that we've seen in the green bond market and the green finance issuance market. So I was curious what you think of that trend. Green finance has just been going gangbusters all year, and the greeniums seem to be getting higher and higher. How sustainable do you think that is? And also, what guardrails are you putting in as you go about doing these finance projects to make sure that companies aren't taking advantage of the discounted financing?
I was just going to say almost everything that gets labeled green these days can be so confusing to clients, even for the most sophisticated of them. Everyone wants to be a green bank, to have sustainable finance and green bonds, to have a great ESG score. And the level of chaos and competing standards and definitions in the marketplace can be, I think, a little bit overwhelming for people. And I think that's an issue, even for those of us in the C-suite. So we do think that this is a place where the industry does better when there are clear standards, and really, rather than just sort of information chaos, we have things like the Carbon Accounting Partnership, which we helped to launch, and I know that others on this line were also involved. And that establishes clear standards that are credible to stakeholders and workable for banks, and it has the potential to be transformative for us. The Partnership for carbon accounting now has more than 50 trillion in assets committed to measuring and disclosing financed emission through a single industry-led standard. And to me, that's an example of what standards can bring to the whole space and provide clarity.
Bevis, what do you think about that the trend of just green financing, and where do you see that market headed?
Well, I mean, a couple of areas really. I mean, green bonds, first of all. I think we really need to scrutinise closely what green bond frameworks actually are. We have publicly stated that we didn't recently invest in the UK government's green bond because it included blue hydrogen and because it included carbon capture and storage, which in itself is not a bad thing, but it is if you're not specifying what industries that plays a role in. All you're potentially doing is perpetuating fossil fuel addiction in the economy and not facilitating a true transition. So I think we need to bring real scrutiny around those green bond frameworks. Then on green finance more generally, I agree entirely with what Priscilla said earlier. You know, we need robust taxonomies, we need labelling. My preference would be that happens on a global level rather than an EU version, a UK version, and et cetera, but I don't see that happening at present, sadly. I think, moreover, we need to be demanding much greater transparency. I mean, we publish every loan and investment that we make worldwide. And I think if people are raising money against green bond issuances or issuing products to consumers that they say are green, then there should be complete transparency so it can be entirely scrutinized.
Jürgen, anything to add?
Yes, by the way, it's great technology. No, we just lost Martin. You were on mute. I think this is the new normal. But back to your question. Markets show indeed increased appetite for green bonds. That's very clear. In fact, green issuances regularly achieve higher subscription in the primary market compared to, let's call it, ordinary bonds. Concerning so-called guardrails, I believe it's all about clear standard setting. Therefore, we as EBRD, we promote the implementation of best international practice and are actively involved in most of the developments in this area, including the work of, I don't want to be too technical now, but the work of the International Capital Markets Association, or ICMA, the EU, and the Climate Bonds Initiative. For example, in our projects, we have been promoting the requirements outlined in the Green Bond Principles for several years now. And according to these principles, issuers must produce a framework in line with very specific criteria before issuance and undertake annual verification and certification of the green bonds by independent parties. And furthermore, by the way, they also recommend very clear disclosure requirement for issuers to provide transparent green commitments. If I may, one more side, EBRD is actually also a significant issuer of green bonds itself. We actually have pioneered new asset classes, including, for example, the first ever issuance of climate resilience bond on the back of our portfolio of climate adaptation projects, and to remain a credible player ourselves and support our clients issue green bonds, we actually apply very stringent standards in terms of investment eligibility and monitoring and disclosure requirement. And our environment and social policy, ESP, is, we feel, in line with international best practice, and our methodology to track climate investment has been developed and regularly updated with the other MDBs and represents what we believe the first of its kind in the financial market. Thanks, Iman.
That's interesting, especially Bevis, you highlighted your critiques of the UK green bond, but that one was 10 times oversubscribed, right? So we're talking about confusion amongst clients, that's Priscilla mentioned, of like what green means, but also the investor base and in the case of the UK bond, sometimes the general public. So is there more investor education that needs to be done around green financing, or do you think it should be on the financial institutions to keep those standards themselves?
I think there definitely needs to be more investor education, and I think Priscilla and Jürgen already spoke to the standards. I think those are very important. I think one of the challenges is banks are operating in different sectors. They're multi-sectoral organizations, and I think the risk essentially is that if they simply take the positive stuff they do and they package it green, but they don't do anything about the neutral or the harmful activities, well, then that's kind of greenwashing. And I think that's why the most important element in setting a standard is that there's true additionality through the green product. And I think, I don't know, unfortunately, I had some internet connection problems just before, so maybe Jürgen already spoke to this. But I think among all the standards, I think what matters most, you can have a wonderful standard, but what is crucial is that if you create a green product, it really has to be additional. And what I mean by that is the project that you finance would otherwise not have been financed if it wouldn't have been for that specific green product that you've created. If you're simply packaging assets that you have anyway in your portfolio and selling it as a green product, well, you don't change really anything in terms of sustainability. And so I think that's the big differentiator. And I think that's the area where we have to educate investors and that they look very carefully and understand the difference between what is additional and what is simply repackaging of what is already there.
Okay, and this is another broad question, last one on this topic, but how much of the green bond market currently do you think is greenwashing versus progressive and productive sustainability projects? Bevis, I'll put that one to you first.
I was thinking Jürgen would jump in. I mean, it's impossible to put a number, which is, I suspect, why we're all looking quite numb at the question. But I think what's been said already highlights that it's a developmental phase, and we need those standards, we need those scrutiny. Outside of green bonds on the banking side, part of the education piece you talked to is having league tables, and excitingly in the UK, which have just produced their first ever rating of savings providers. Fairer Finance is another one that are trying to do it. But I think that's where we need to get to, and that will really make it clear to people the sort of standout offerings, whether that's on green bonds or savings products, whatever it is.
Okay, and Jürgen, here's one for you. How are you talked about your work that you're doing in emerging markets. So how are you balancing the ambitious sustainability targets with the reality that so many emerging economies are still heavily reliant on fossil fuels?
Yeah, you're quite right. Very good question. But let me start by saying the EBRD in its heart is a transition bank. It was established to help countries transition to market-oriented economies, and it is now helping countries transition to zero-carbon economies. And we know that this does not happen overnight, and it requires a combination of policy, of capacity building, even of concessional funding to kickstart investments in emerging markets. And a little while ago, I said I would give you an example. So let me use this example right now. And this is the economy in Egypt. Egypt is one of our larger countries of operation. It is mostly reliant on fossil fuel generation, with only 8% share of renewable energy in 2016. And that was largely from hydropower. And Egypt's NDC lists renewable energy as one of the main 5 policy pillars to achieve GHG emission mitigation, and stresses the importance of replacing and upgrading obsolete infrastructure. Furthermore, Egypt has set renewable energy capacity targets of 20% of its electricity mix by 2022, so next year, and 42% by 2035 as part of its integrated sustainable energy strategy. And to support these objectives, we, meaning the EBRD, approved in 2017 a $500 million framework for the development of a 1.8 gigawatt Benban complex, the largest solar park on the African continent and one of the biggest in the world. And I visited there myself before lockdown, and the scale is just amazing. And at the same time, we developed a proposal for the Green Climate Fund with the government support to raise capital for the project. And since then, EBRD and GCF have together financed 8 of the 16 projects that comprise Benban. And we also have mobilized, and I go back to one of the comments earlier, over 140 million capital of private investors that has contributed to building investors' confidence in the country's renewable energy sector. So a real life example how things can be done.
Thank you. And Martin, I was just asking Jürgen about how he balances the sustainability targets with the reality that so many emerging economies are still reliant on fossil fuels. How are you helping them transition? And how do you pick your projects there?
Yeah. Yeah, I think there's still a myth that fossil fuels are more expensive than renewable energies, and I think the reality is that, well, first of all, let's face it, the markets are not fully working in the sense that that the true cost of fossil fuels isn't really priced into the market, and so I think there's a bit of a challenge there to take the right policy decisions. What we hear from our members in the emerging markets in the global south is that the price of renewable energy has come down so much that it has actually become really a true opportunity. And many of our members are entering into solar finance, of course, not at the level of EBRD financing these huge parks, but really more smaller, decentralized solar power plants, small-scale hydropower plants, and wind power. And they seem to be able to make a very good business with that. So I think what we're really seeing here is a big opportunity. In fact, many of the
Oops, and I think we lost Martin again. Let me add
That's too
one
bad.
more thing to Martin, actually. And he said something about not the scale of EBRD. And this is a question, of course, to my other colleagues. I always learned at school, actually, from my previous boss, if it's not scalable, it's a hobby. And I think this current climate crisis actually deserves scalability. So hence why I'm not ashamed of using big amounts. But over to you, Priscilla.
No, I have nothing to add to that. I think great points made.
Okay. Well, Priscilla, you can take this next one. This one is for both you
Okay.
and Bevis. But as sustainable banks, you guys branded yourselves as sustainable banks a long time ago. But we're seeing ESG go mainstream, and you're seeing very large banks and financial institutions embed that as part of their branding. So, how do you plan to stay out? To continue? How do you plan to continue standing out as ESG goes mainstream?
Yeah. So how do we plan to prevent becoming like the Kodak example that was given earlier? And I personally am just thrilled and excited to see it being mainstreamed. I agree with you. I think it's exciting for investors. It's exciting for the younger colleagues in my bank and other places. It's exciting for our future, frankly. And so I think there are really two big reasons why the relevance of the values-based institutions like Triodos and other members of GABV and Amalgamated. I think we're all going to be essential going forward. And it's not only that we believe in doing good and doing well, it's also that we are influencing other larger institutions and the public debate more broadly. But ESG has still not completely turned the corner in terms of proving its impact in every area and among all stakeholders. And I think that means that the product shifts may not have yet resulted in true shifts in capital. So the point that Martin was making earlier about additional capital. We've all seen the charts where the top 10 holdings of an ESG fund are the same as the benchmark. And then the other reason that I think we are important and will continue to be in the society is that, our challenges as a society still exist at a disturbing and often outrageous scale. Um, Racial and economic inequity, the climate crisis. We could go on and on. Immigrant issues of fairness and justice across the board in the U.S. We think a lot about voter rights. We think about women's reproductive rights. I mean, there are just a number of significant issues for us to address in addition to climate. And certainly the crumbling of our civic fabric is important to address. So our role as values-based institutions, always striving to do more, has particular importance in the context of all of these challenges. We always have to manage being great banks and doing everything we can to execute on our values at the same time. And that's really important balance that we try to strike. We know that as we grow, we have the potential to have even greater influence. So our growth is important. So we deliver real value by doing all that we do. And I would argue that we bring something that is important for the finance sector and for our clients who deeply share the same values and affinity for what we're trying to accomplish. We have a lot of partners across, in our case, 6 segments in American society who rely on us and partner with us to achieve a number of great gains.
Thank you. Bettis?
Well, I mean, very briefly, I mean, I think, do I worry that the world starting to think about ESG is going to mean that values-based banks and other, like Triodos and other GABV members, become obsolete? No, because of what I said earlier. We're not doing kind of just low-level ESG. We're really trying to do measurable impact and deliver impact strategies against the Sustainable Development Goals. And I think, we continue to play a role in that regard. And I think most of the GAB memberships have very fast growing sort of customer bases and are demonstrating financial performances over and above some of the mainstream players nowadays. So I think, that's how I view the landscape. I don't think we'll be the Kodaks or the Blockbusters. The reference I was making earlier is to those that don't really embrace that more sort of holistic view of sustainability and do more than just think about carbon and bare minimum standards in ESG. And I noticed in the chat somebody asked about, do you think you'll see lawsuits and so on? Well, we've already seen the first successful legal pursuit of a superannuation fund by its pension members for continuing to invest in fossil fuels. You've already seen sort of proactive share action against banks that haven't sort of met their stated commitments to reduce their fossil fuel lending. So I think we live in times where, the Kodak blockbuster scenarios are there for the mainstream, and the sector needs to wake up to that.
All right, thank you so much. Unfortunately, we have to leave it there as we're getting close to time. But I want to thank each one of our speakers so much for taking the time to share their insights today at the FT Live Banking Revolution Conference. As a reminder, the session will be available on demand on the website for 30 days. And you can stay tuned for the next session, which is a discussion on whether or not fintech can successfully tackle the issue of female inclusion in financial services industry. So thank you so much, and hope you join us for the next session.